Hi class, this is Liz Brown with Richland College Financial Accounting, and I am going to go over some important topics in this chapter and work a problem with you. Please be sure to read the chapter and also to look at the other resources I've posted out on eCampus. And if you have questions after this video, please let me know by posting something on the discussion board, and I will get back to you as soon as I can. This chapter covered several topics. We talked first about net revenues, which include discounts, returns, and allowances. We'll go over this briefly. The AR aging, we'll cover that in our example here. Writing off AR. Now, I am using the term AR here. That is a common abbreviation for accounts receivable. So on this, that's accounts receivable aging and writing off accounts receivable. Allowance versus direct write-off method, and notes receivable. Here we have our dealer. Just a refresher here that this side on the left is increased with a debit. DR stands for debit, so dividends, expenses, and assets. The other side, liabilities, owner's equity, and revenue, are increased with a credit. Let's review a couple of these topics and then move on to our example. This was in our text for an example of what net revenues looks like. So this is our service revenue and any sales revenue. Now note that any reductions for trade discounts are done to this number, and we will have a contra revenue, so it will act in the opposite direction of a revenue, so it will increase with a debit for sales returns, sales allowance, and sales discounts to get our net revenue. So please take a look at the book for details on these. The important thing to remember here is that it shows our financial statement users more relevant and better information, and it shows them this was our service revenue, but here's how many returns, allowances, and discounts that we had to get to our net revenue. Here, just showing you the example that's in the book for the allowance versus direct write-off method. So what's important to know is the allowance method that we'll do an example on here shortly is showing revenue recognition in the period we do the service, and matching of the bad debt expense in the same period that we recognize the revenue for our service or our sales. So what we're seeing in the year of the adjustment, we'll have revenues recognized and a bad debt expense, and contra asset will increase here with $2,000. And in the year the write-off is made, we will have no net effect to the income statement. As you can see, allowance for uncollectible accounts is a balance sheet account, and accounts receivable is also a balance sheet account. So no effect here on the income statement. So no net impact on the balance sheet. The direct write-off method is shown here for year 1 and year 2. Direct write-off method is not GAAP. So most companies you will work for will not use direct write-off method. This would be used at a company for tax purposes, or if they're not expecting any bad debts. What we see here is in the year of the revenue, so the year you recognize your revenue, there's no adjustment. The following year, that's when you'll take a bad debt expense and a reduction to your accounts receivable. So what we're seeing here is we have our revenue that is recognized in the proper year, and our matching expenses in a different year. So the difference here is timing, right? So the same accounts are hit. They both have a bad debt expense. They both have a reduction in accounts receivable, but we follow the revenue recognition and the matching principle under allowance, and under direct write-off, we have just a different timing, and we're not following that matching principle. Let's move into an example here, class. We are looking at an example of an orthodontics doctor's office and the AR aging schedule they're providing as of December 31st. So what we're seeing here is that total AR or accounts receivable are $80,000 at the end of the year. This is what our customers owe us. We have these separated into buckets. That's a term that you can use in the business world of what these aging groups are. So $40,000, not yet due. It is highly likely that we will receive those accounts receivable from our customers. So we estimate that only 4% is uncollectible. Then we age these out longer and longer. So 0 to 90, 91 to 180, and then more than 180 days past due. We have $13,000 that is over 180 days past due. We are estimating that 80% of these are not going to be collected. So this is going to be our bad debt. We're expecting 80% to be uncollectible. Now you might wonder how we get these percentages. These are based on previous collection history, and you would speak with your external auditors and your management and decide what the best percentages are. This is something where your company is directly affecting what the expense is going to be, and when you have an estimate that's directly affecting your expense, you could potentially have the ability to control your net income. So we want to make sure that we're ethical and that we do the right thing and that we really are able to back up the percentage that we use here for our uncollectibles. All right, so let's jump into this problem here. Additional information. Services provided in 2021, that's just telling us that we have $590,000 of services. We have $80,000 that is still unpaid at the end of the year. That's up here. And we see that we have a balance in our allowance at the end of the year with a credit balance. This is really important to determine the direction of $5,000. So let's go ahead and look at that. We were told that we had a credit balance on our allowance for uncollectible. We can see here on dealer that assets like to be increased with a debit, but we are dealing with a contra asset, so it likes to be increased with a credit. So we have a credit balance. That means that it has a balance in our allowance for uncollectible, and we have $5,000 in that. So given this information, we're going to go ahead and close out 2021, and we're going to look at what we're going to have for our total amount that we estimate as uncollectible. So how we're going to do this is we're going to take the amount and simply multiply it by our percentage. So in this case, we're going to take 40,000. We're going to multiply it by 0.04. We assume, or we are estimating, that of this 40,000, 1.6 thousand will be uncollectible. Now this is an estimate. We don't have a crystal ball. We do not know what will happen in the future. For the next bucket, 16,000 at 20%. So I'm going to take 16,000 times 0.2. And for 91 to 180 days, we're going to take 11,000 times 0.25. And for more than 180 days, we're going to take 13,000 times 0.8. What we have going on here is a sum of these numbers here for 17,950. That will be uncollectible. So when we show our balance sheet, which we're not doing here, but when we show our balance sheet, we want to show our financial statement users that we have 80,000 in accounts receivable. We do not believe that we'll receive 17,950. So we are going to have a net accounts receivable of $62,050. So let's do our requirement at the end of December 31st, 2021. We're going to estimate our bad debts here. What we're going to need to do is we're going to need to get our balance in our allowance for uncollectible to be 17,950. Please take a note of this. We are going to do our bad debt expense entry. We are not going to book 17,950 in our bad debt expense unless this is our first year or we know that our T account has a balance of 0. We are dealing with, I'm going to flip back over here, we are dealing with a balance sheet account. Right? It is a permanent account, not a temporary account. We always need to consider what the previous balance is. So what we're seeing here is that we have $5,000 balance here. We know, based on our aging, that we need the balance of our allowance for uncollectible to be 17,950. Well, what do we need to do to get there? 17,950. We need to figure out what number we need to put in our allowance for uncollectible and do a journal entry to get us there. So what we're going to need to do here is we're going to need to book 12,950 so that we can have those two numbers add up to get to the 17,950. Now the entry that we're going to put here is we can tell that we're going to need to credit our allowance for uncollectible for 12,950, and we know that we need a matching debit. what are we going to put here? This is where we're going to have our expense. All right, so I want to make sure that we see that we're not going to book this $17,950. That is not our bad debt expense. It is our balance for allowance for uncollectible accounts at the end of the period. And we need to look at that permanent account and figure out how we're going to get there. All right, so I really recommend using T accounts here. We have one customer. Now remember, we have an AR aging, so we have lots of customers. So we're going to look at one of these customers, and we get a notice that they are not able to pay. So we're going to write off their account on 7/19/22 of $8,000. Here is the entry we had in the previous year for customer 1. We recognized revenue for our service of $8,000 and accounts receivable of $8,000. And we put this in our T account, accounts receivable for this customer number 1 of $8,000. Last year we recognized the revenue. This year we still have that permanent account of $8,000 in accounts receivable. And we found out that they are no longer able to pay us. What we need to do is we need to make their accounts receivable 0 as they're unable to pay. So let's come in here. To do that, we're going to need to have a credit on our accounts receivable account. Now don't get tricked and think that we need to debit our bad debt expense, right? Bad debt expense was put in this entry last year. If we debit bad debt expense again, we will be double counting the bad debt from 2021. What we need to do is we need to put this in our allowance for uncollectible. We have $17,950 set aside for bad debts from prior year. So we need to come over here. We have a credit of $8,000. We need to have a debit of $8,000, which will make the allowance for uncollectible account smaller. So here is our new balance in allowance for uncollectible, reducing it $8,000 to $9,950. So let's do this journal entry here. We're going to have a debit to allowance for uncollectible, reducing that account by $8,000. We have the credit to accounts receivable here. The next thing our problem is saying is that we collected written off account on 9/30/22. So it looks like the account that we were told would not be paid actually was paid to us on 9/30/22. So here's what we're going to need to do. We look over here, and if customer 1 wants to give us $8,000, we say, we don't even have an accounts receivable balance for you. So we need to do several things. First, we need to reinstate their accounts receivable balance. So we need to undo what we just did in this previous journal entry. To do that, we're going to need to come over here and book an entry for $8,000 here. So that will give us a new accounts receivable balance of $8,000. And then we need to come over here to allowance for uncollectible. We reduced this account by $8,000, but we didn't need to. So we need to add this money back because it is available now to cover other bad debts that we might have. So we're going to put the $8,000 back into this account, and that balance, the allowance for uncollectibles, will now be $17,950. Let's update the journal entry. So we're going to come in here and we're going to have a debit to accounts receivable of $8,000, and we're going to have our allowance for uncollectibles. We're going to add back that $8,000. Now we need another piece of this journal entry, and that is to recognize the cash that we're actually receiving. We're going to be receiving cash with a debit of $8,000, and we're going to be paying off our accounts receivable in the same amount of $8,000. All right, guys, I hope this example was helpful. Just a quick recap. We had our used our aging to multiply the amount of AR times the percentage to get what we needed our allowance for uncollectible accounts to be at the end of the period, which was December 31st, 2021. Then we updated our bad debt expense. We looked at our allowance for uncollectibles to calculate, so we had to do some math here to calculate our bad debt expense. Then we wrote off $8,000 and then from a customer, and then we came back and reinstated that balance, and received the cash from them.